Ready to go.
This is our retail update for the first quarter of 2023. It's been certainly an interesting quarter on deal flow and what things are looking like. So we're going to dive in to just what we're seeing in the market, why it matters to us in the net lease space and retail, and then what actions we're taking because of this, and then ultimately how our distributions are looking and how our deals are performing. So if we go into the market first and what we're seeing right now, the biggest factor.
Well, there's a theme. There's a theme that everybody knows about, hopefully by now, and I think it's pretty common. But debt is the entire market theme right now. Debt is driving the market. The Fed is trying to slow the economy down, and at least on the Greenleaf business, it's working. Our deal volume is down. We're not finding the deals that we were finding last year, and so their strategy is slowing us down, which is disappointing, but it's also, it's a good breather for us to kind of recapture what we're doing, making sure our business strategy is correct, and also to look for the next opportunities. And that's what we're doing right now.
They certainly, the rise in interest rates have certainly slowed down the deal flow that's out there, but it's coming from a couple different angles where we've got sellers who are not really adjusting to rising interest rates.
Right.
They're not interested in selling at a discount, or they'd rather just hold it and keep the cash flow that they're getting at that point. And then buyers who want to pay less, or they've got a higher debt cost and they're unable to get to a seller's price. And then there's also kind of this lack of, with overall transactions slowing, there's less 1031 funds available. And then that means you've got less people coming into the net lease space.
Well, and there's opportunities in that too. I mean, first of all, what's happening is the inventory is starting to increase. And so the sellers are becoming bigger than the seller pool is becoming bigger than the buyer pool. So the seller pool is becoming maybe the same, but the buyer pool is shrinking. And so eventually that's going to put pressure on pricing. And so I was given a statistic by one of the local brokers, and he said there's just a glut of inventory on the market. Like there were 100 plus Starbucks, 90 plus 7-Elevens, almost $700 Generals, 60 Chipotles, and 350 drugstores. Now, when there's a glut of inventory, what should happen? I mean, the prices should go down.
At some point in time.
They have to go down, or you just don't sell. But, from our standpoint too, we're selling deals. We're going to list a couple of deals this year, and we're going to sell deals maybe a quarter point off of what we expected to sell it, but not something that would put us in a desperate mode.
Us in a bad spot.
Honestly, we would rather just hold the asset and collect the cash flow and wait for cap rates to adjust, and then sell the asset when appropriate. But right now, if we can sell an asset for 25 basis points higher than what we did last year,
in those examples, we're still selling deals that are in the low sixes on cap rate.
Yep.
Which, when we're going out and we're trying to get debt in the market right now, we're paying in the sixes, kind of our quotes for debt that's out there.
6.25, 6.5 are the last quotes we got. So, and there was just another increase too. And so,
So transaction volume hasn't gone to zero. There's not like a complete seizure of the market. So it's still happening. There's still transactions. Just right now, there's definitely that gap between the buyers and sellers. And in our case, we're on both sides. So we are selling, but we're selling at a lower cap rate than we would buy at. So we're not finding a lot of opportunities to buy. So I think within the market and kind of what we see going on, there's going to be a reduced amount of transactions for foreseeable, probably at least a few months going forwards here of what this looks like.
I hope it's only a few months rather than
a few quarters.
Yeah, a few quarters. Yeah.
Hopeful for a few months versus a few quarters, but there's definitely some tightening here to stay for a while until we look at a situation where do owners have to sell at some point?
Right, but don't forget too that our retail strategy is working. I mean, the triple net leases are stable, the income is predictable, and there's a high quality guarantee behind it who will weather a storm. And honestly, our restaurants and Dollar Generals, they're not seeing a decrease in revenue.
No, their revenues are doing well, and I think we look at the point of they made it through COVID. That's one hurdle, and then now they're trying to tackle this inflation battle that has happened over the past 12 months. So I feel like a business that's made it through those two significant hurdles over the past 3 years in operations, like you've got a strong team getting it through that stuff.
Well, and the stuff we own, we own restaurants that appeal to a middle income demographic. And so that middle income demographic is a huge demographic. And honestly, if people are going to dine down, they're going to dine down from a local fancy restaurant to an Applebee's, or if they're going to dine down more, they dine to a Zaxby's. And so our products, there will always be a customer for the things we are selling. We are not buying what's the fancy steakhouse.
We're not doing anything that's high end.
We're not doing anything, because the high end places, the high end restaurants, the high end retail, those are the businesses that are going to be affected right now.
Yeah. So, all right. So when we think about what's happening in the market and why does it matter for us, we're always thinking about what is our strategy and making sure we have a strategy that is effective, that is in that current market. So right now, what we are doing is looking at deals where we have a good amount of equity. We can still get not the lowest cap rate that we could get 12 months ago, 8 months ago,
Correct.
But a good cap rate that we can exit at. So we are still looking for opportunities to realize gains and exit at cap rates that are in the low sixes. So when we have that, that's what we're seeing.
With a nice return to our investors too. So we're still in double-digit returns for everything we're looking at exiting this year.
Yeah, and then what we're doing overall. Certainly, if we can exit and make some gains, perfect. But our strategy going forward is of how do we operate in this market, knowing what we're seeing, not only on the transaction side, but how the businesses are performing. We're still looking for these short-term lease opportunities. These are becoming harder and harder to find, right? I mean, they're certainly there, but they are definitely harder to find, ones that have a short-term lease. And that compression between the value of a short-term lease and a long-term lease, it used to be a wider gap. And that curve has flattened.
If we just back up, we would buy a 7.5 cap deal last year, and then we get 3.5% debt. So then the spread between that was 400 basis points. And the cash flow on that deal is remarkable, and we can do that over and over again and get we could pay all of our preps, we can get a nice profit at the end of the renewal of the lease, where you'll get a 5 to 10% rent bump, and so then we could sell that at a premium after the rent bump. And those are great long-term cash flow deals. Right now we're looking at reliable businesses that maybe have 1 or 2 years left on their lease, probably 2 years left on their lease. We have sales, we have foot traffic data, we know it's a good business. And then we're going to buy it, say at the same 7.5 cap, but we're going to get a 10 or 15-year lease on top of that. And so then we're going to create value by moving from a 7.5 caps value to hopefully like a 5.5 or 6 cap value. And so we have a 150-point spread between the value we created and the value we purchased at. And then unfortunately or fortunately, these are short-term holds. And so we're going to hold these properties for probably about a year. Our IHOP in Texas, we're doing that with. We got the long-term lease. And as soon as we hit the year mark, so we get long-term capital gains, we're going to put that up for sale.
Yeah. And we're doing that right now with another asset that we have too, where we've owned it for just over a year. It's performed well. We have 6.5 years left on that lease, and we can exit at a lower cap rate, and we're going to make over 20% IRR on that transaction if that all goes through.
Right.
So that's what we're looking to do. That is really our business plan going forward. Now, finding these is going to be harder and harder. It's not getting easier on what opportunities are out there.
No.
But
you could see by the amount of volume we're putting out right now, the volume has definitely lowered. And so our deal guys are getting restless.
Yeah, no shortage of looking at deals. We still get to do all of the deal hunting and looking through stuff. It's just harder to find ones that will actually pencil out.
Yep.
So that's where we're at in the retail segment. We look at our deals and how they're performing. So retail, going into many of these deals, we knew we were walking into a situation where we are expecting to make consistent quarterly distributions and produce cash flow for our investment pool. So every deal that we have is
Every retail
distributing this quarter.
deal is paying. If they're not paying prefs, they're paying just under prefs. Like for those are
so
good problems.
Consistently making cash flow distributions every quarter. So if you're invested in the retail deals, all of those checks, they'll be going out on the 20th here. So it takes a day or two for those to hit your account, but they'll be there. So we're very excited about overall performance there. We have had some exits that happened that, leading up to this quarter.
Right. Well, we could talk about 2022, and then we could talk about what's looking our 2022 portfolio, and then we can kind of move into what 2023 looks like.
Yeah. So we sold some dollar stores. We sold Old Charlie's.
Right. We sold Old Charlie's in Q1. We sold the Whiskey Road Strip Mall in Q2, Dollar General in Q3, and Taylor's, and then Dollar General in Statesville in Q4. And all of them were remarkable dispositions. We had Charlie's ended up with about a 14% internal rate of return, and the Whiskey Road Strip Mall was a 48% project return, which is great. And
that was a winner.
That was a winner. And one of our investors says it had babies because we took the proceeds and pushed them forward into 2 other deals. And so now that one purchase, for everyone in that one purchase, they now own three purchases. They own 3.
Through a 1031 exchange.
Through a 1031 exchange, so it was tax-free, no one paid taxes on it, and we just pushed it forward, and we improved everybody's cash flow too. And then Taylor's was a 7% return, which is pretty good, project return, and then Dollar General Statesville was a 25% project return. So I think that's pretty good.
Good solid numbers in that in that environment where we had the cap rate spread to debt. It worked out very well. We're still looking at, like we said, we're looking at an exit right now that will sell around a mid to low 6 cap.
Right. We have one property that somebody came to us off market and they just made us an offer, and it was a very reasonable offer, and so we're looking at that right now. Yeah. But that was unplanned, but we do have some planned dispositions right now too.
Yeah. And any of that stuff too, we'll have that in the property specific write-ups as you get in the investment reports on all the specific details of what that actually is. And we have the only other asset we have that's a non-franchised operation, right? So one of the first deals that we purchased, excellent location. It's right here in Atlanta, and we're looking at exiting that one as well.
Right, and that's purely you call it a land play. So right, it's the
great location.
Great location. It's location. Desirable area. Properties sell for nice premiums because of just the area. It's always busy. It's always hopping on the weekends, and it's more of a it's a downtown. It's our Edgewood property, and it's just
we've owned real estate on that road for almost 15 years now, and it's always performed very well. The road in that area of town, it continues to grow and see redevelopment opportunities. So we were excited about getting the opportunity to buy that one, and we renovated and repositioned that asset. And there's a successful restaurant that's in there right now, and they're looking to acquire it. So if they do come through and acquire that one, that'll be our only non-franchise location that we are able to sell. And we have a good outcome. I mean, a good outcome for us and a good outcome for that local business owner. They're going to own their restaurant and their real estate, so they'll be in a very good position personally with their investment as well.
Right.
So.
And we have another QSR restaurant we're looking at listing right now too, which I'll leave the surprise to everybody for
as we figure out the details.
We figure out the details, but we're looking at just selling one of our QSR assets too, and we'll see what happens. So really, we only have maybe 2, maybe 3 dispositions planned for 2023 right now.
Yeah. So overall for the year, I mean, we're gonna keep trying to find stuff. We're gonna look to take advantage of opportunities we see where there is equity, and everything we hold is making distributions. And we are excited about the cash flow that it's able to spit out. We're excited about providing the investment returns out to all of you on a consistent quarterly basis. All right, thank you very much. That's all we have for this end of quarter wrap up. We're going to have a live Q&A session next week as well that we'll get invites out for, and please let us know if you have any questions. For more tips on operating and investing in real estate, please check us out at greenleafmanagement.com or find us on YouTube and Spotify.